Hello, everyone. Hello, and welcome to another SARE National session. My name is Jenny Anchondo, and I'm here as your host and moderator for today's session. So we have a lot going on today. It's actually part two of something that we started last week, but don't worry if you were not here last week because we will be getting a recap, and you do have that session out recorded. We are on the 5 C's of credit part two with our friend Isaac Elizondo. So before I tell you about him, if you're not familiar with him, I do just want to draw your attention to the chat bar on the lower right-hand side. That chat bar is your go-to spot for all of your questions, all of your concerns, anything that you want to put forth, and perhaps anything that you want to pose to Isaac. This really is our opportunity to lean into him, to lean into his wisdom and ask questions. So I'm kind of your eyes and ears for this. I will be monitoring the chat. On the back end of his presentation, you will get a Q&A session. So anytime that something comes up and you're wondering a question for you or your business and you want to pose it to Isaac and you think, gosh, I wish I had him right in front of me. Well, you do. You have him in front of you and you can send any questions to me and I'll be able to facilitate that on the back end. So just send them in. I'll be over here taking notes, getting ready for my own questions as well. But if you're not familiar with Isaac, he has worked in the banking and financial services industry for more than 18 years. And gosh, he's won several awards in the retail banking area for his goal setting achievements. So prior to his banking career, gosh, he had a big career in the commercial real estate industry, mostly in land acquisitions, office leasing, and development. Also worked as a small business owner for a short time in the insurance and financial advising field. Ended up selling that company and joining one of the largest community development financial institutions in the United States as a regional director. Now, I mean, my gosh, the bio goes on and on. He is now working with United Texas Bank promoting CRA loans. So specifically with this, and this is why it's such an important, he's such an important person for what we do specifically here with SARE. He's helping women, he's helping minority businesses. He's also helping low to moderate income areas seeking financing through the United Texas Bank loan program. So he's just a wealth of knowledge when it comes to finances and your business. And again, the 5 C's of credit part two is where we are today. So the plan is that I'm going to mute myself. At this point, I become a participant like everybody else. I'm here for you, Isaac, if you need me, and then we'll do some Q&A on the back end. Isaac, welcome back. Good to see you.
Yeah, thank you. Thank you, Jenny. Appreciate that. And yeah, thank you for having me back. I really do appreciate it. So yeah, let's get started. I know we left off. We touched on the first topic, right? I mean, we had several topics that we were going to cover. Obviously, the 5 C's of credit. We'll be discussing today the credit report, business line of credit, business loans, the different types of loans out there for small businesses, whether it's startup or existing businesses. So we'll cover that. But before I start off into part two, let's go ahead and get started with a recap of the 5 C's. I know we had a lot of vocabulary going on. We had the qualitative and quantitative, right? So we'll recap the 5 C's, and of course, having an understanding of a mixture of what banks are looking for within those 5 C's. Again, I mentioned qualitative and quantitative being a mixture of the 5 C's, right? Again, qualitative, that's very subjective. You're looking at things such as their management experience. You're looking at your bio history, years in business, the industry cycle, the environment of the industry overall, strengths of the business. This is subjective, right? Banks will look at that. Then they'll mix it in with contrast to the qualitative, which is quantitative. Again, focusing on all the numbers. Those are the facts. Balance sheet, income statement, tax returns, your personal financial statement, personal tax returns, all of this being incorporated with that. So the two techniques, qualitative and quantitative, being mixed and using it together with the 5 C's will evaluate the potential overall ability to pay back the loan, therefore qualifying you for the loan. I'm sorry, I'll start sharing my screen right now and we'll jump to, again, just really quick to recap the 5 C's. Jenny, can you see my screen?
Yes, it just popped up just now, and I'm seeing the
Okay.
recap part one of the five C's of credit, and then
Oh,
your graph
okay.
there.
Good. Let me, I'm sorry. I wanted to go to the five C's right here.
Totally fine. Yep,
Um,
we got time.
okay. So again, as I said before, the five C's of credit all are character, capacity, capital, collateral, and condition, right? Capacity, debt to income ratio, right? That's your measures the reliability. Sorry, measures the ability to pay back. Again, we're looking at debt and cash flow coming in. Capital being the next one, again, indicates the borrower's level of seriousness, right? It's your commitment. You know, what do you have in the accounts? Do you have the percentage, 10 to 20%, that you're required to have? Some lenders require that, some don't. But again, that's capital. That's the level of seriousness. Collateral, again, that just offers the assurance that if the borrower defaults on the loan, the lender can repossess the collateral. So again, thinking about what you own as a company, as a business, that could be anything. And think about it too, is if you're a startup, again, I mentioned that last time, it could be your desk, your laptop, a chair, anything. So think outside the box sometimes with that. But anyway, we all have collateral of some sort. Next one is conditions. That's actually factors the amount of principal, the interest rate, measures the timing of the business. So that's condition. Character, right? We talked about character, not just about meeting you, talking to you, right? That's credit history. We're going to look at credit reports. So all of that, five C's, are incorporate all together. And again, qualitative, quantitative, all of those are mixed in together to kind of assess whether or not you can get a loan or a line of credit. So again, my last one that I spoke about, that leads us into our credit report. And I'll get us started right here. So, credit report. What is the credit report? Several things. Well, what is a credit score? Sorry. So banks actually look at multiple things when you're pulling your credit report for a potential borrower. The credit score is a three-digit number, right, that lenders use to determine the risk of loaning money to a borrower. And all companies, credit card companies, auto dealers, there's mortgage bankers, all types of lenders actually check your credit score before deciding how much they're willing to loan and at what interest rate. Also, I'm not sure if a lot of people know this, insurance companies look at that. Landlords can look at your credit score to determine how financially responsible you are before issuing insurance policies or renting out an apartment. So a lot of these things actually affect you in life. And remember, not just as a business owner, you are a consumer. And so that's all incorporated as well. Uh, Everything that you've done in life, will also spill over as a business owner. So making sure you have all of that in check on your personal side will determine whether you get a business loan or not as well. Um, So let's move forward here. Again, these are some of the things that look at: credit scores, accounts, late payments, past dues. There's collections and charge-offs, bankruptcies. A lot of this goes onto the credit report. And so this is something that the banks will definitely look at. And let's go ahead and dissect uh, the credit report itself. What does it comprise of? And here we have different types of percentages, right? So the first 35% reported payments and payment history, right? So your payment history, excuse me, it carries the most weight. It factors the effect of your credit score because it reveals whether you have a history of repaying funds that are loaned to you. So the component of the score considers the following factors right here. Have you paid your bills on time? For each account on your credit report. Paying late has a negative effect on your score. Um, if you paid late, how late were you? Were you 30 days, 60 days, or 90 days? That's something they're going to look at. So the later you are, the worse it is for your score. What else? Have any of your accounts been sent to collections? This is a red flag for lenders. You might not pay the bank back. So this is something that they're going to look at. Have any of your accounts been sent to collections? We covered that. Do you have any charge-offs or debts, settlements, bankruptcies, foreclosures, any lawsuits, wage garnishments? Or liens, any public judgments. These are things that will actually come up on your credit report as well, and we factor all of that as well. Now, all lenders will look at that. Here at UTB, at our bank here, we actually don't have a minimum credit score or a maximum or anything like that. We actually do look at the credit report itself. So again, this is really important to keep things in check. Um, What's something else I could add to that? The time since the last negative event and the frequency of missed payments affect the credit score deduction as well. So, for example, someone who missed several credit card payments 5 years ago will be seen as less of a risk than a person who missed one big payment this year. All right. These are things, again, just taking an overview or look. So the next one, 30%, how much of your credit score is in use? So FICO, which is our credit rating, takes into account your credit utilization ratio. So this actually measures how much debt you have compared to your available credit limits. And the second most important component looks at the following factors right here. So how much of your total available credit have you used, right? If you've used if you've used high credit limits, then lenders will be less likely to believe you can manage more debt, right? So how much do you owe on a specific type of account as well, such as a mortgage, an auto loan, credit cards, installment accounts? So credit scoring software like that actually looks at a mix at different types of credit that you can manage them all responsibly. So I want to say that again, it just depends. If you're going to a credit card company, going to a mortgage company, come here with a bank, depending on what bank, we all use different types of software to gauge that. Okay. So again, it just really depends. So in saying that, what else could be added to that 30%? How much do you owe in total? That's a big deal. How much do you owe compared to the original amount of the installment loan? Again, less is better. I guess an example of that would be someone who has a balance of $50 on a credit card with a $500 limit will seem more responsible than someone who owes $8,000 on a credit card with a $10,000 limit. All right. Um, so next, 15% length of time you've been using the credit. This is important. Banks actually like to see how long you've had the credit in use. So for many years, how long have you had the obligation, right? So how old is your oldest account? And what's the average age of all of your account? Something else, long credit history is also helpful. So, but this factor, it actually has less of a weight because borrowers actually with short history may have proven that they have payments on time and don't owe too much. So again, this is why some personal finance experts recommend leaving actually a lot of your credit card accounts open, even if you're not using them. Again, just leave it open. That definitely affects how that's used. I myself, I had a situation like that. I opened a credit card back in college. It was $200. And I've had that for several years, had it maybe for 12, 13 years. And then I got a random call from the same company, from the credit card company. And one of their people said, "Hey, we got this new credit card, blah, blah, blah." And they sold me on it and said, "Okay, no problem." Not thinking that they were going to shut my credit card off, but they did. They canceled the credit card and they gave me the new one. But that my history started over. So 13 years of history completely disappeared. Yeah, I was pretty upset. By the way, and I didn't really realize that till several years later. Seriously, like 4 years later, I realized. that happened to me, and I was frustrated. And again, you can't do that anymore. That's illegal. So they have to notify you what they're doing, et cetera, et cetera. But again, history is important for sure. So I'm just giving you an example of keeping an eye on everything. So let's see. The next one here, new credit. So 10%. Yeah, sorry, 10% new credit accounts. Yeah, so they consider, you know, how often you're getting. So what can I say on this? It factors the accounts if you have applied recently or consider the last time you opened a new account. So whenever you're applying for a new a line of credit, lenders will typically do a hard inquiry. So that's called a hard pull, right? Which is the process of checking your credit information during the underwriting procedures, right? So this is different from a soft inquiry. I guess that's kind of doing a scan of your credit score or your credit report, and also maybe just something basic like retrieving your own credit information. But I tell you, a lot of banks are going away from that soft inquiry because they're finding out at the soft inquiry, you can go through it, and then when you get in there and they do the hard pull, you filled out everything, then you do the hard credit pull, then a lot of major things will come out. So a lot of banks are not doing that. A lot of other lenders are not doing that. Again, that would be a preliminary check, but a lot of time is wasted actually when doing things like that. So just FYI on that. And you do want to ask about that because hard pulls can cause a small and temporary decline in your credit score as well. So, why is that? Well, the score really assumes that you've opened several accounts recently, and the percentage of these accounts is high compared to the total number. So then you could represent a greater credit risk. Um, People, I guess, tend to do so when they're experiencing cash flow problems. That's why. So they get a little nervous that there's too many inquiries. So definitely try to keep that at a minimum. Um, and then another, let's see, last one, 10%. Uh, yeah, variety of credit accounts you have. So, yeah, so this last one, the formula actually considers it determines your credit score is whether you have a mix of different types of credit, such as credit cards, store accounts, you have installment accounts, your mortgage. It also looks at how many total accounts you have. So since this is a small component of your score, you really don't have to worry about it or type of accounts in each category, and you don't have to run somewhere and say, oh, I need to open this or this or this so it can approve it. Again, it's only 10% when looking at that. Let me go ahead and let's move on. And again, that totals 100%. So 100% worth your time to monitor um, your credit report. So really big factor. Moving on. All right. So credit scores. So we pull from here at UTB, we pull from only two major credit bureaus, the Equifax and the Experian. TransUnion is also pulled when wanting to do like here, like a mortgage for small business loans. And so, every lender though, you got to ask them who they use, what credit bureaus, because there are some lenders that actually only use TransUnion. Other ones will use Experian, and some will use all three and take the average of the three. So that's something that you'll have to ask them. But another thing, just to make a note that like Equifax, Experian, and TransUnion, they don't communicate with each other. So that's why if you ever looked at these three credit bureaus, they all have a different number for you for whatever reason. There's a lot that goes into that mathematical equation, but they will have different numbers, and that's why some use all three, and then they just take the average of the three. You might have a high TransUnion, but a low Equifax or Experian, or vice versa. So that is something to think about. So what is a credit score? Again, this actually predicts how likely you are to pay back a loan on time. And here are the measurements. It ranges from 300 to 850, and of course, the higher your score, the better, and the greater chance of you getting a loan. So this is pretty much accurate as far as 300 to 300, 629 is bad, 630 to 689 fair, and then 690, 719 good, and then 720 to 850 excellent. And again, a lot of lending institutions will go by that, especially if you're dealing with mortgages, credit cards, those types of lenders. And that's overall what they're looking at. Banks, business loans, absolutely. They're looking into the credit report, and some banks actually have that certain criteria of a certain credit score, a minimum, right? So when you're applying for a business loan, the lender is actually going to look for the total existing monthly debt obligations as part of determining how much debt you can afford as a startup business or for an existing business. Of course, cash flow plays a very important part of this. I don't want to downplay that at all, but definitely the debt you have on that credit report is very important. So keep that in mind. Also, again, I did touch on that, but I do want to reiterate that if you've recently opened several new accounts, such as credit card accounts or a vendor account, that might indicate that you're planning on going on a spending spree, and that makes lenders very nervous as well. Okay, so keep that in mind. Uh, and that's why I always tell like small business owners, please come to the banks, get your line of credit, get your line of credit before you really need it, or the loan prior to what you're going to be needing. Because when you're rushing to the bank trying to open this, that's when problems come up, and things just look bad. A variety of reasons. It could be a number of reasons, but that's why I say when things are quiet and calm, that's when you want to get the line of credit, right? So keep those things in mind as well. Let's see. Let's go ahead and move on. All right. Okay. So, yeah. So what accounts? So the three major accounts that banks look at for here are actually real estate, mortgages, commercial properties, industrial land. They look at installment loans, uh, term loans. That could be a car loan, a personal loan. That's an equipment loan, right? That's a term loan. We'll go into more detail later on the differences of the line of credit and the terms. Revolving line of credit, credit cards, revolving lines of credit. There's vendors that are providing lines of credit to you as well. And other ones that we'll look at are the medical bills, cell phone bills, utilities, rent. All of that plays into that. Um, so please keep that in mind as well. I felt like I wonder if there was anything else that I wanted to add with that before taking a deeper dive for the credit accounts. I guess I wanted to give maybe a couple of points as far as what can you do to make sure that your credit score stands in good condition, or these types of real estate installment loans, revolving lines of credit. How can you keep that in good standing? And one thing I want to say for like your credit cards, business credit cards, or a line of credit that you might already have. So making sure that you're keeping an eye or watching your credit utilization ratio, that is really important. So keep your credit card balances really around 15 to 25% of your total available credit. So that's something you want to keep, that 15 to 25%. You know, just be careful. We get a little nervous when we see these credit cards completely maxed out or over capacity. That's a bit of a challenge, right? So again, pay your accounts on time. If you have to be late, well then don't be more than 30 days late, right? Another thing, don't open lots of new accounts all at once within a 12-month period. That's actually a really bad idea for sure. And again, just make sure you're checking your credit score every 6 months in advance if you're planning on making a major purchase. So again, buying a car, getting a house note, uh, just keep an eye on that. So yeah, just wanted to add that note. So again, sorry, here are the credit bureau report bureaus, the Equifax, Experian, and TransUnion. If you'd like to take a photo shot of that, if you need to get in contact with them, I definitely recommend maybe putting a freeze. A lot of people are putting freezes on their credit, and when they go and they go to the bank, they get a business loan or getting a line of credit. We tell them, hey, you got to freeze, and then you unfreeze it, and then we'll run the credit, and then you can close it again. I like that for extra security. Anyone doing that also with mortgages or credit cards, anything like that. Just on a funny note, just make sure that you take those freezes off before you do it, because you'll get a decline. I myself, I did that one time. I forgot I had a freeze, and I applied for a card, was trying to get this deal with no payment type thing, and they declined me, and I was completely shocked. I was like, "What? My score is perfect," and et cetera, et cetera, and then as I'm talking to them, I was like, "Oh, I got a freeze on my credit on all three of them." So it will decline you, but it won't say anything. It just says it's just decline. So you just have to remember you have a freeze on that. So it's a great security feature, by the way. So those are the three. Again, so this is a credit report. This is actually something that we would see on our end. This is actually an example of late payments and past due and how they can affect you. And so, again, like I said before, we really look at those installment and revolving loans and lines of credit, right? That's an example right there that in red, a past due, 8,437, and then the past due $70 right there. Those are the payments that they're making, right? So there you can see right there 30, 60, 90. And so you can see this person here's 30 days past due twice, and then 60 right there once. And then, of course, at the very bottom, it has total as far as past due 13,900. And then it gives us a total as far as how many accounts in delinquency. So that's just an example. And again, historical delinquency at the bottom right there, authorized user account, the installment revolving, and it tells us the last delinquency. What was the month and year that you were delinquent? Okay. Again, shows right here, 30 days past due. The last one was like 12 times. Again, 60 days, 7, and then 90 plus days, 38. And again, total, it gives you the whole bottom. So this is something that we look at, and we definitely keep an eye on. And again, it makes us nervous if they're recent. In the past, it's fine. Happened 4 years ago. It's okay. Just we do like to have an explanation though, what took place. And we're looking for patterns. Is this a history? Is this a pattern? Is this actually something frequent? We see something happening every 2 years. Well, then there's an issue that could definitely get you declined. So that being said, I guess we can move on. All right, so let's talk about the different types of loans that we have, or which, the variety, right? So there's two types. There's the loan, which is the term loan, and then of course the line of credit. So again, the line of credit there provides businesses with access to money that can be used on a temporary use, right? So it's not like a loan. You just pull money out as you need it, and then you pay back, depending on the terms of the lender, right? So the small business line of credit can be subject to credit review and annual reviews, and is revolving like a credit card. So the interest begins to accumulate once you draw on the funds, and the amount you pay, except for the interest, is again available to the borrower as you pay down your balance, right? So it's a line of credit functions like a credit card, all right? And of course, the number one reason actually to open a business line of credit is to gain access to short-term funding. So most businesses use these funds to support financing, operational expenses, payroll, supplies, inventory. Again, these are short-term, right? If you're planning on buying, I need a utility truck, or I need a forklift of some sort, this is not what you would use this for sure. Okay, it's a high cost, and obviously that's what we consider long-term debt, right? So this is an example of what a business line of credit should look like, a revolving line of credit usage. So, on average, you're looking at a 12-month period, it should be going up and down, right? So you're using it, 30, 60 days, 90 days, and then dropping it down to zero. That we would look at as a very healthy use of your line of credit, for sure. Making sure that you're not really carrying those balances or leave a balance on a line of credit. We would be very alarmed by seeing something like this. Again, having something with a line of credit, not bringing it down, it just kind of has a lot of alarms there, because you're, again, not able, you don't have the cash flow to bring it down. Again, a variety of reasons, but they're definitely not good at all by carrying that balance. Here at this bank, actually, and other banks, actually, if we see that the line of credit is not being used the way it's supposed to be, we would just pretty much term it out. We'd close out the line, and we convert it into a loan, and give you a fixed rate. And that's why these lines of credit have variable rates, so they fluctuate based on the Federal Reserve. And so I think a loan would be a lot better and less. Of course, it's fixed, so you know exactly what you're paying. So yeah, business term loan. So this provides a business with a sum of cash up front in exchange for a specific lending terms from the lender. So the loan is used for a large one-time purchase, like I said before, like a forklift, utility truck. It could be an investment. Again, it can be used for cash flow gaps. But again, common purchase made with the business term loans are properties, real estate, machinery, and equipment. So the loan will be repaid to the borrower in scheduled payments based on a set of period of time and a fixed or variable interest rate. Of course, we here have a fixed rate for that. And of course, the loans range from 12 to 60 months, depending on what the loan will be used for. So keep that in mind. Those are the two differences. Now, again, can't get into details as far as the terms, right? Because every bank has different types of terms. Here at United Texas Bank, our line of credit, ours is interest-only payments. So whatever you're taking out, technically you only have to pay the interest on a monthly basis. That's all. That's the only thing you need to cover. Others don't. Some actually will have a part of what you withdrew and then interest added to that. Credit cards function in that way as well. But again, all lenders are different. So you're going to have to read the fine print and just ask your loan officer or your bank representative how do they determine their payments. Okay, something to consider. And oops, 1 second. Yeah, actually, yes, I did. And I thought I had one more slide in there. I do not. So we have come to the end of part 2 on the 5 C's of credit. And 1 second. Yes, Jenny, I am done with that. If we can take me off the screen. There you go. Thank you. Appreciate it.
Isaac's just trying to get off the screen.
I was trying to get off the screen. That's what I was trying to do. Okay.
Oh, that was awesome. That was really, really helpful. So I just wanted everybody to see that his information is up right now, and it's really generous of him to share that info with us. So if you're, thinking, okay, well, I need to get some funding, or I'm trying to, use his services. If somebody was going to reach out to you, who would be like an ideal client, partner, person that would reach out to you? What types of services do you provide?
Well, we we cover well, we are focused on small businesses. I mean, honestly, it can be anyone. We don't do I guess perishable items. So like restaurants or bakeries, we won't work in that arena, but everyone else we definitely will. And not to say that we would in the future. So please keep that in mind. But as of right now, that's the one industry we're not working with. So
Isaac, I feel like that's a real big error on your part to not work at bakeries. I'm just saying.
yeah, I know they're delicious. Exactly. So we have a special program here. It focuses on women entrepreneurs.
Very cool.
It focuses on minority, low, moderate income, and so a lot of there's a large percentage, right, that are restaurants, and so bakeries, and so yeah, I'm doing my best here to kind of make that change, make some headway. And I'm even coming with some ideas as, hey, okay, maybe we can't do 25 or 50,000, but what if we can do 5,000 or 10,000, something small, right? Uh, so I'm here, I'm committed to that. I'll circle back with
Awesome.
you, Jenny, for sure,
Yeah, yeah. No,
when
no,
that
no.
comes
For my
out.
bakery. I'll see if you're ready. So,
Yeah, and yeah, go ahead.
oh, we got a good question in, and I wanted to pose it to you. Somebody who has a construction company, they're looking for funding that can be used for certain contracts that need to be paid before the work is done. There's a couple questions in here, so I'll pose that to you first. What type of funding would be used for that?
That would be a line of credit. That sounds like a gap. That sounds like a cash flow gap, right? So I know, especially with construction, you're looking, especially if there's government contracts, whatever. I mean, that's 60, 90 day plus days. So yeah, that's exactly what a line of credit is for. You want to take the money out, you pay whoever you need to pay, your subcontractors, whoever you need to pay, and then when you get the money, pay the line off immediately. So
Okay,
yeah,
so
that would go into that. And we do deal with contractors, construction, all of that. I'm sorry, contractors again. We don't deal with startup buildings or anything like that.
so the line of credit, it's a 30-day when you have to pay it back?
Yeah, 30 days. Again, it'll start to accumulate interest after that point. Correct.
Okay.
Yeah.
And would that be what's an interest rate on something like that, or does it just totally?
Well, for our special loan program that we have that I'm promoting, it's actually prime plus zero. Prime plus zero. So prime is 8.5 right now. And it's based on the Federal Reserve. Whatever the Federal Reserve has it at, that's what we have it. And we're not charging anything extra. So it's zero. Typically that'll be either 1 or 2%. So it's prime plus 1 or 2 out in our normal world, or
Yeah.
banks will charge. But we're charging prime. That's it.
So, and ideally somebody's paying it off right away, and so it's nothing, right? Like they're as long as
Yeah.
they pay it off
Yeah.
within 30 days.
Exactly. And what I like about our line of credit, again, it's interest only payments. That'll hold you over. So hey, as long as I pay the interest, I'm good. You'll have the principal there of what you took out, but you're just paying the interest. All
Okay.
right. So that's important.
Okay, that's good to know. So also, this person's looking to buy equipment for their company, wondering if it's best to get one big loan to cover everything or to get two loans, one for each. Like if there's two pieces of equipment, should they be on different loans or should it be one big loan?
Yeah, they should be separate depending on what type of equipment as well. This could be short-term equipment or long-term equipment. So it really depends. But yeah, and of course, banks, we won't do that. It'll be individual loans. If you're getting an excavator or a dump truck or something like that, those are two separate loans. They'll have to be separate. Um, uh, yeah, for sure. And of course, getting a loan, you can do that. And then also the strategy would be get a line of credit. So maybe you get a 20,000 line of credit and then get these two loans for these equipments. You never know. And some of the equipment in contracting or there tools that you're using for a special project, all of that, maybe that can go on the line of credit and it can be repaid back. It just depends. It's a matter of just sitting down and having that conversation with the banker and be thorough. So yeah, tell me exactly what you're buying, give me the list, and then we can kind of go from there and assess it.
Okay, okay, that's helpful. So because it would be different, and Is that always the case? Is that, I guess I'm trying to figure out, is that more savvy for him, or is it just the way it has to go? Because when you apply for a loan, you have to indicate it's for this one.
Yeah, it's a collateral. It's really based on collateral. Well, for the most part, it's strategy for the business owner. I think it's smart strategy. I definitely will. That can actually, again, it just depends on what it is. But for me, I consider it the strategy, the line of credit, and then keeping the loan separate. Combining it all together, uh, you know, well, you could refi, I guess, a debt of some sort. Again, we probably would not do something like that. And yeah, for sure. But for the business owner, I think it's keeping things clear and clean. I personally think that's just a better way to go. But again, another banker might have a different opinion.
Okay, that's
Yeah.
helpful to know. So you just
So
want to call whoever you are and just be upfront with them, like this is what
yeah,
I need to
this is what I want.
purchase.
Yeah, exactly. And obviously, yeah, it really depends. And of course, here at the bank, I guess we would do that. I know like at a CDFI, um, they work with a lot of startup. They work with construction as well. And depending on what the items are, they can do a whole loan for the company. So they can do a loan for the company itself. So, okay, here's $50,000. It's collateralized. You have several equipment. They can do the one chunk, just one loan. And then again, you can buy the equipment that way through the company, making those purchases as well. But it just really depends on what the equipment is. So yeah, it's a matter of talking with your lender.
You were talking about soft hits on your credit. Would like let's say this person is going around to different financial institutions and trying to buy this equipment and figure out who's going to give me the best deal. Will each of those meetings with those banks or credit unions be a hit?
Yeah, that's why you got to talk to them before they run your credit or running anything. I would recommend a soft pull. You could have an idea, right? Just do a soft inquiry and just you need to ask them though, is this a soft inquiry? Is it a soft pull or is it a hard pull? Because you're right. If you're going around and you're rate shopping, it will bring down your credit score. It could bring it down maybe three points or 4 points. But then it stays on your report. So by the time you get to the sixth lender, they see that and they're like kind of wondering what's going on, or they get an idea. Okay, this happened within 30 days, 60 days. So you were just looking, making it. So that's okay. I mean, you can kind of figure it out, but you still want to question that, and you'll talk to the business owner exactly what exactly were you doing, and we don't want any surprises, right? You're getting a loan here, and all of a sudden other stuff pops up. We'll catch that. Like now you got a loan here, and now you're trying to get a loan at multiple places. What exactly is going on? So banks don't want to see that, by the way.
Okay, so don't like go to one bank and be like, okay, I'm going to get this piece of equipment here, and then like I'm maxed out with them, so I'm going to go the next day to this other bank.
Some other bank, yeah. Usually, yeah, yeah. You don't want to do that, but it usually won't work because it's based on cash flow. I mean, banks are going to loan you. Hey, we got this debt here, so now you got more debt. If you go to another bank, well, you're not going to cash flow usually. So it's that
Mhm.
situation you want to be with one lender to start off.
That makes sense. So
Yeah.
somebody's asking, what if the only collateral I have, the only collateral I can offer at this point in time is my home, my single family home? Can that be used as collateral for a business loan?
Yeah. Unfortunately and fortunately, depends on what side you're on. Yeah, Texas and Florida are the only two states we have homestead laws. We cannot use homestead as for a business loan at all, or collateral. Sorry, we can't use it for collateral.
So what do you use? What does somebody?
Oh, by the way, if for that, I mean, if we're talking like a startup, or you say you're in business, I mean, you can look at a home equity. Again, I'm going out of my expertise, but if it's clear and free, you go to your bank and use a home equity, and you can take the funds out and kickstart your business that way. But again, that's done through a home equity. You're going to talk to your CPA. How do you figure that out? And that's a whole other strategy. So I'm just throwing my personal opinion on that one. So. But yeah, that's one way, and people have done it. I'm working for a CDFI. Um, uh, Again, there, not here, but we work with startups, and sometimes that was one way if we couldn't find a solution, that was their homestead, getting a home equity that way. So we've had those conversations there. Again, here at the bank, no, we work with companies that are 2+ years in business, by the way. So we don't really work with startups in that sense.
Okay, so you're like the collateral like is the business or
The equipment that you have in the business, yeah, the equipment that you have in the business, correct,
okay.
correct.
Like
Accounts receivables, that could be it, right? You have money coming in, depending on your business, depending on what it is. We could use that as collateral sometimes, accounts receivables, depending on your industry. So
the
yeah, that's
if you
one way.
started doing bakeries, you could take all the bread, like who knows?
Well, that's the thing. You really, and that's why
Ovens.
banks don't do that, Jenny, because we can't take the bread. We can't take,
Oh, come
it
on.
doesn't, can't take the food home.
Ah,
So
bags of
that's
flour.
no.
Oh
In
my
that case,
God.
no, exactly. So.
So, okay, we were talking about freezing credit, how that's just a wise thing for people to do. What's the process like to unfreeze? Say somebody's like, okay, I'm frozen while I'm working my business behind the scenes. I'm kind of preparing everything, and then they decide, all right, it's time to go get my money. Is that a lengthy process to unfreeze?
No, actually not. You can call them. You can actually do it on an app as well. You can unfreeze it. There's one I know it with Norton Life. I know I unfreeze it there. I go there. Yeah, I can unfreeze them right away, and then we run the credit. As soon as you know it, you put the credit back on, and so it's pretty quick actually. Yeah.
Okay, got it.
Yeah.
Now,
So anyway, that's a security measure. I like it. It's, just protecting small business owners. A lot of people don't know about that. I know it's been around for a while. And then of course you think, wow, it's kind of hard. I got to go to all three and all of that. But there is a way to do that. And again, it's just to protect you. And I just think it's a smart way to run your business and protect yourself as a business owner. So we've seen a lot of things happen like that.
is this like the next day? It's just unfrozen?
Yeah, yeah, actually the same. It can be done in an hour. So right now, it's 4 o'clock, and I'm gonna go in and I unfreeze it. They run the credit. Hey, 5 minutes later, I freeze it back up, and it should be done in that time frame. So, yeah,
So I've heard of people freezing their kids' credits. I know it's like off topic for this, but kind of on topic. Do you think people should do that? Like,
that's interesting. Yeah, that's totally off topic. Yes, I would recommend it for sure. I recommend. I'm a security guy. I definitely would do that, and because lately, right, we're seeing a lot of that. I'm seeing a lot of things where it's 3-year-old, they took a credit card out in the 3-year-old's name, and you don't know, right, how they're going to get information. So no one's going to know until several years later, or whatever. But yeah, that's interesting. Yeah, that's a great idea to do as well. Yeah.
add that to my to-do list and add that to
Yeah.
everybody else's to-do list. So when somebody is looking at these, financing options for their business, like let's say that they're starting out with just really not much at all, and they're thinking, okay, I need equipment. I also need to pay somebody. I also need to like hire somebody to do the build out for my business. Are all of those things separate loans, or again, is that going back to that earlier question about the lump sum?
Yeah, it's a lump sum. Well, it's interesting though. That's a startup, right? And so again, there could be equipment involved in that, right? But that's a startup loan. And again, the CDFIs, they work in that arena. And so, yeah, I mean, like I just gave the example, hey, they could do a one package loan, 30,000 to the company, your startup. Here you go. This is what you have. This is what you're going to buy. They work in that world, and they could do something like that for sure. And if you are a startup, my recommendation is going with the CDFI, a local CDFI. There's several here for the Dallas Fort Worth area.
And then once people have been in business for a while, then they come to you, and then
Yeah, yeah, that's the mission of the CDFIs. Their mission is really to help you get financing where you can't find financing through traditional means like a bank or for-profit lender. So their mission is to provide the funding to you, graduate you into the banking world. You should never stay with the CDFI. But again, of course, some do. Restaurants and bakeries, they tend to stay in the CDFI world. But others, yeah, you want to graduate into the banking world. And it's funny, we say at the CDFI, and when I was working for the CDFI, that was our mission. We like losing customers. We're looking for new customers, and we're graduating off to the banks. And so the CDFI world for startups is definitely the way to go. Yeah,
Okay, yeah, that makes sense. And then once they get with you, then it's kind of like they're expanding. How does somebody know when it's time to, like, they worked with the CDFI, they've been going for a couple of years, like, okay, we think we need to do more, but do we
yeah,
want to take on more debt?
yeah, yeah.
What's that analysis like?
Yeah, that's really on the business owner. It's kind of funny. There are some people that are so loyal to some CDFIs. I remember they never wanted to leave. They can actually go get a loan with the bank, but they never wanted to leave because the CDFI was there at the very beginning, you know. So a lot of them are loyal. They'll stay in the CDFI world. But hey, some CDFIs are capped at certain dollar amounts, right? Some can only do up to this X amount or dollar amount. You might be at a higher level. You might need 500,000 or 600,000. Some can do it, some can't. But honestly, you want to be working in the banking world. You definitely want to have a line of credit. And just also, I want to make a note is definitely, hey, there's nothing wrong with keeping a loan there with a CDFI, but having a bank partnership as well. So, okay, they give you a loan. How about a small line of credit with the bank? But keeping a variety of financial institutions as partners for your business is really key. And it's even with us. Like if you have a relationship with us, you should have a relationship with another bank and a CDFI. You can have a combination because you just never know. Hey, I need funding here. They can't do this and you've got to move quickly. So if you're working with three finance companies, you're adapting to an environment that you don't know that's coming down the line, right? So in small business, that's the one thing that you need to be ready for. It's change because business is always evolving. So you just really have to adapt. And I think financing is what holds a lot of business customers back. And working with one institution really might not be a solution. So just making sure you have that variety there. Hope that answered your question. I hope that helped.
Yeah, no, it does. And I just want to let everybody watching know if you have any other questions, we've got a couple minutes, so feel free to write in. We can kind of get into specifics. If it's something he doesn't do, he'll say, that's not what I do, but it's nice to be able to just have this kind of casual conversation where you don't even have to show your
Yeah,
face. You don't even have to worry about asking a silly question. And I
yeah, yeah,
think it can be a little bit intimidating too when people go in. It's like, oh, they have this idea, I want to start my business. And then by the time they get to you, they maybe have a little bit more confidence. They've been rolling. But it can be very intimidating going in and thinking, do I have what it takes? How can somebody be best prepared for that conversation when they come in to meet with you?
yeah. That's good. A great question. The first step is again financial literacy, and I want to draw back to financial literacy. A business advisor. There are several that we can go to that are free of charge. SBDC is one of them. You have SCORE. You have a lot of these organizations out there. There's another one called Equal, and they're doing really great things out in the community. Of course, that's a for-profit. Those are for-profit business advisors, but um, again, getting an advisor would probably be the first step because they'll help you or guide you with a strategy because you need a plan, and then they'll see, okay, are you ready? The business advisor will tell you, are you ready for a loan or a line of credit? Is that the level you're at, or can you continue where you're at with the cash that you have on hand? Um, and then if you're ready for a line of credit or a loan, those business advisors will actually help you. They'll help you, get to that point. And some of them have connections with other lenders and banking world, and they kind of know the landscape of the banking world. So they can say, hey, I think this bank will likes your industry, so you should go here, or you do this type of industry, you should go over here. The advisors should have that knowledge, and they for the ones that I have interactions with have for sure. So yeah, that'd be the first step.
Oh, yeah, yeah, because certain banks, probably the people that work at them understand certain industries. So you mentioned a piece of equipment or you mentioned the thing, oh, yeah, yeah, we've done that before. We understand what that is, that sort of
Yeah.
thing.
Yeah, exactly, exactly. So we definitely want, yeah, go that route for sure. Yeah, go that route for sure.
Okay, that's great. And then what's that relationship like with that person over time, over the years? Is it like you're checking in with them? Are you saying, "Hey, look, we're doing great," or is it just like you make your payments and you move on?
No, oh, well, no, that's no, that's wrong. Well, for us here, we're we're right next to you. We're right by you. All my clients, I mean, we're a small bank. I mean, we're like 76 employees. I mean, it's really tiny. We do things a little old fashioned, and so when people are wanting to make a withdrawal from the line of credit, they email me, da da da, and I'll call them, confirm, and so, hey, how you doing? We have a conversation. Yeah, I'm making a withdrawal. It's 20,000 or 10,000. Oh, wow. Great, great. I'll make that transfer for you. And then we'll have a conversation. What are you using it for? Things like that. So you'll talk to me through this whole process. And then every quarter we do a check-in. We here at this bank, at United Texas Bank, we require quarterly financials. So we're looking at your balance sheet and income statement. So the first year you're with us, we're growing that relationship. So the first year, every quarter we're just watching how it's growing. What direction are you going? And then the second year it's biannually and then annually once a year. But again, we're in constant contact, and that's the way it should be. That's the relationship. You have a checking account, you have a line of credit, you're using the account wisely and smart. Like we could see what's going on. And that's how we do it. Now, yeah, there's some lenders out there, high volume lenders, great lenders. They do business loans, but yeah, you just get the loan and hey, maybe you see them again, maybe you won't. Be 2 years later, 3 years if they're still around. That's just their business model, and that's how they operate. And here at United Texas Bank, yeah, we don't do that. So we're here through the whole process.
Well, that's nice, right? I
Yeah.
mean, gosh,
Yeah. Oh yeah.
I mean,
Yeah, I like it.
yeah, that is really nice. Well, Isaac, thank you so much for all of this information. I've actually learned a lot. I think that the people watching have learned a lot as well. And don't forget, y'all can scroll up and you'll see his information, his phone number's on there, his email address, name, everything like that. So you can reach out and, maybe
Yeah.
start the beginning of a lifelong lending relationship.
Absolutely. Please do call me. Again, I know I can't do it. I'll send it to people that can do it. So I know a lot of people in the banking world, CDFI world. I know who can do what, and so I don't mind helping you and guiding you. Hey, we don't do that, but here you probably go here. So yeah, I can help out.
That's awesome. That's fantastic. Isaac, thank you so much. It was great to connect with you and everybody who's on today. Just know that if you missed something during this, you logged on late, the replay will be up on Sarah National's YouTube channel by Wednesday. So just before the next session, then we'll be back here, same time, same place, 3 p.m. Central Standard Time next week for another great event. We'll talk to y'all soon. Bye-bye.